Welcome to the Pro Ticker Deep Dive.
It's great to be here to dig into this today.
Yeah, today we are taking you on a custom-tailored exploration of a massive structural shift happening in the global financial system right now as we sit here in early 2026.
It really is massive.
Right. We are looking at the very foundations of money, of trading, and ownership being completely rewritten from the ground up. Our mission for today is to understand how the traditional imposing walls of Wall Street are they're dissolving into the digital blockchain-based world.
It is a profound transition. I mean, if you look back just a few years, the traditional financial world, what we used to call TradFi and the cryptocurrency universe, they were treated as parallel and very often hostile ecosystems.
Oh, absolutely.
They spoke entirely different languages, they operated on completely incompatible technological infrastructures, and had deeply conflicting regulatory philosophies. But today, we are watching them execute a mega merger. The boundaries aren't just blurring, they're being actively dismantled and rebuilt as a single, unified global ledger.
And this matters for you, the listener, because it fundamentally changes the mechanics of how your capital operates. Just imagine a reality where your investments never sleep, where you can buy fractional shares of global real estate at 2 a.m. on a Sunday right from your phone.
Yeah.
A world where your idle cash automatically hunts for the absolute best yield across the globe, seamlessly, without you having to lift a finger. That infrastructure has been laid, the switches are being flipped right now, and the way you interact with capital is changing forever. Okay, let's unpack this. Starting with a recent development that perfectly illustrates this new reality. The owner of the New York Stock Exchange just bought into a major crypto giant.
Yes. Intercontinental Exchange, or ICE, the Fortune 500 powerhouse that runs the NYSE. They have taken a strategic minority investment in OKX.
Which is huge.
It's massive. This deal values OKX at $25 billion. It shows the incredible premium that traditional finance is currently placing on established, globally scaled digital asset platforms. But it's far more involved than ICE simply writing a check for an equity stake.
I want to pause on that $25 billion valuation for a second. That is a heavy number. It puts them in the exact same league as some of the most established legacy financial institutions on the planet. But you mentioned this isn't just a passive investment. What are they actually doing together?
If we connect this to the bigger picture, ICE is taking a board seat at OKX. That means the institutional-grade rigor, the governance, the regulatory expertise of the company that runs the most iconic stock exchange in the world. That is all now directly embedded into the strategic decision-making of a crypto platform.
Right.
But the technical integration is where the real value lies here. They are actively merging ICE's proprietary pillar matching engine with OKX's blockchain-native execution stack.
Hold on, let's translate that. For those of us who aren't, software engineers building trading systems, what is a matching engine and why is this pillar system so important?
So a matching engine is the core software of any financial exchange. It's the algorithm that takes all the incoming buy orders and all the incoming sell orders, and it pairs them up based on price and time priority. It dictates how fast a trade executes and ensures the market functions fairly. ICE's pillar is arguably one of the most sophisticated high-throughput matching engines on Earth. It is the absolute heart of traditional U.S. equities trading. It processes billions of shares of Apple, Microsoft, Tesla, all during New York trading hours with microsecond latency.
So they are taking the software engine that runs the New York Stock Exchange and plugging it directly into a decentralized 247 global crypto network. What is the business strategy there? What does ICE actually get out of giving OKX access to their crown jewel technology?
Distribution and data. Mostly distribution to start. ICE immediately gains access to OKX's 120 million global accounts. Furthermore, ICE is going to license OKX's spot crypto prices to launch U.S.-regulated futures contracts.
Why do they need to do that?
Because ICE wants to capture the pricing efficiency of one of the world's largest spot markets. But they have to package it into a regulated product. They are building a bridge for institutional fiduciaries.
Let's clarify institutional fiduciaries for a second. You mean entities that are legally bound to manage money safely, right? Like pension funds or university endowments.
Correct. A state teacher's pension fund cannot legally or operationally just open a wallet on an offshore crypto exchange and start buying Bitcoin. Their compliance mandates strictly forbid it.
Right, they'd be audited into oblivion.
Exactly. They need a regulated traditional wrapper, like a futures contract, traded on a U.S. exchange to gain exposure to that asset class. ICE is building that exact product using OKX's underlying data. And on the flip side, subject to regulatory approval, of course, OKX gets to offer its crypto-native users access to ICE's U.S. futures and eventually NYSE tokenized equities.
I get the theory behind that, but is there actually retail demand for it? Will a user in Jakarta or Sao Paulo who is used to trading digital tokens all day really care about accessing traditional U.S. financial instruments?
The demand is substantial. You have to remember, historically, access to U.S. capital markets has been a privilege reserved for those within the traditional banking perimeter of the developed world.
Ah, that's true.
By offering NYSE tokenized equities through a globally accessible app, you bypass the legacy gatekeepers entirely. Someone who previously only traded digital assets will soon be able to access the exact same U.S. financial instruments as a Wall Street trader, all through the same interface.
But if you are integrating a traditional Wall Street engine with a 24/7 crypto exchange, you hit a pretty obvious logistical wall. I mean, Wall Street goes to sleep on Friday afternoon, crypto doesn't. How do you settle trades on a weekend when the underlying banking system is closed?
You've identified the cash leg problem. Traditional clearinghouses, the entities that sit between buyers and sellers to ensure trades actually settle and money changes hands, they operate on strict banking hours. They rely on central banks and commercial payment systems like Fedwire.
Which are definitely not open on a Sunday.
No, they are not. So if a global trader needs to meet a margin call on a Saturday, they are fundamentally stuck. The legacy financial system is offline. To solve this, ICE is working closely with mega banks like BNY and Citi to support tokenized deposits.
What exactly is a tokenized deposit? How is that different from me just looking at the digital balance on my Chase checking account app?
The balance you see on your banking app is just an internal ledger entry at that specific bank. If you want to move that money to another institution, the banks have to reconcile their ledgers through a central clearing system,
Which takes time.
And only operates during business hours. A tokenized deposit, however, is a programmable cryptographic token issued by the bank that represents a claim on a deposit. It lives on a blockchain, not just the bank's internal server. Because it's on a blockchain, clearing members can transfer that money continuously around the clock in seconds.
So it satisfies margin obligations and funding requirements in real time, regardless of whether it's 3 a.m. in New York or Sunday in Tokyo. You literally can't have a 247 trading cycle for global equities if the underlying cash is stuck operating on a Monday through Friday schedule. But I have to ask, banks issuing programmable money on blockchains, the NYSE plugging into crypto exchanges, none of this would be legally possible under the regulatory environment we saw just a few years ago. Banks were essentially terrified to touch this space. What changed the calculus for the regulators?
We witnessed a complete political and regulatory thaw. The shift in the environment over the past couple of years is the primary catalyst for everything we're discussing today. The U.S. government made a hard pivot to fulfill promises of making the United States the crypto capital of the planet.
And that wasn't just talk. We saw the creation of a national strategic Bitcoin reserve.
Right. It materialized into real legislative action. And the most foundational piece of that puzzle was the passage of the Genius Act in July 2025.
Let's break down the Genius Act. It established the first comprehensive federal framework for stablecoins in the U.S., but there is one specific provision in that act that seems to change the entire dynamic of digital money. It allows for interest payments on stablecoin holdings. Why is that such a big deal?
Because historically, if you held a stablecoin, a digital token pegged to the U.S. dollar, like USDC or Tether, it functioned like digital cash under the mattress. It didn't yield anything for you. The company issuing the stablecoin took your actual dollars, invested them in short-term treasury bills, and kept all the interest for themselves.
Which is a great business model for them.
Incredible business model.
Yeah.
But the Genius Act explicitly allows the issuers to pass that yield along to the token holders.
Okay, so it turns a static digital dollar into a yield-bearing asset. But the act also created a new regulatory body, right? The Stablecoin Certification Review Committee, or the SCRC.
Yes, the SCRC is composed of the Treasury Secretary, the Chair of the Federal Reserve, and the Chair of the FDIC. Their primary function is overseeing stablecoin issuance. But what makes their authority so intriguing is that they can grant exemptions for non-financial companies to issue their own stablecoins.
Let's pause and explore the implications of that, because it sounds like we are opening the door for massive consumer brands to become banks. Think about Starbucks.
That is the perfect example.
They currently hold roughly $1.77 billion in unredeemed customer gift cards. Right now, that's just stored value locked within their coffee ecosystem. But Under the Genius Act, with an SCRC exemption, could a company like Starbucks become an actual stablecoin issuer?
Theoretically, yes. They could take that customer capital, hold it in a reserve, issue a Starbucks digital dollar, and earn a yield on those underlying funds. And they could potentially pass a portion of that yield back to the customer in the form of rewards or interest.
But if consumer brands start acting as stablecoin issuers, holding billions in deposits and offering yield, aren't they just shadow banks at that point? I mean, what happens to regional banks if everyday consumers start treating commercial apps like high-yield savings accounts?
That is exactly the systemic risk the banking sector is grappling with right now. It completely blurs the line between a commercial enterprise and a financial institution. If retail deposits migrate from regional banks to corporate-issued stablecoins, it drains liquidity from the traditional banking sector. That directly impacts their ability to issue local loans or mortgages.
Wow.
The Genius Act handled the stablecoin side of the equation, but the regulatory puzzle needed another piece to clarify the rest of the digital asset landscape. And that brings us to the Clarity Act of 2026.
Right. The Clarity Act seems aimed at resolving a decade-long turf war between regulatory agencies. It explicitly narrows the jurisdiction of the Securities and Exchange Commission, the SEC, over digital assets. And instead, it classifies most digital assets as commodities under the jurisdiction of the Commodity Futures Trading Commission, the CFTC. Why does it matter who regulates it? What is the functional difference between an asset being a security versus a commodity?
The difference in compliance costs and market structure is profound. If a token is classified as a security under the SEC, the entity issuing it must undergo rigorous, wildly expensive registration processes designed for corporate stocks. The trading platforms must register as national securities exchanges. It creates immense friction for decentralized software protocols.
In commodity.
Commodities, overseen by the CFTC, operate under a very different framework. It's primarily focused on regulating the derivatives markets and policing spot markets for fraud and manipulation without requiring the software developers to act like public companies.
And right now, we are seeing unusual teamwork between the agencies. SEC Chairman Paul S. Atkins and CFTC Chairman Michael S. Selig are actually hosting joint roundtables to eliminate what they call legacy jurisdictional silos.
Which is unprecedented.
It is. But beyond just getting along, there have been very specific policy shifts. The SEC recently rescinded a piece of guidance known as SAB 121, replacing it with SAB 122. Now, I know the banking industry fought bitterly against SAB 121. What was it and why were they so frustrated by it?
SAB 121, or Staff Accounting Bulletin 121, was a directive from the SEC that forced any publicly traded company, including banks that safeguarded crypto assets for their clients, to record those assets on their own balance sheets as liabilities.
Give me a real-world analogy for that, because if I put a gold bar in a bank's safe deposit box, the bank doesn't put that gold bar on its balance sheet. It belongs to me.
That is precisely why the banks were outraged. Under traditional custody rules, client assets are held off balance sheet. SAB 121 forced banks to treat crypto custody differently. Because banks have strict capital reserve requirements, adding billions of dollars of client crypto to their balance sheet as a liability meant they had to hold a corresponding amount of highly liquid capital against it.
So it just made it too expensive.
Exactly. It made custodying digital assets incredibly capital-intensive and effectively too expensive for major Wall Street banks to participate in.
So by rescinding it and replacing it with SAB 122, which grants firms discretion based on actual risk, they essentially allowed the major Wall Street banks to enter the crypto custody business without bankrupting their capital reserves.
That's right.
We also saw the Department of Justice announce they would stop targeting crypto platforms for the unwitting actions of their users, and the Treasury Department removed sanctions on the privacy protocol Tornado Cash. We are just imparting the facts of the policy shifts here, but the aggregate result is clear: the regulatory ceiling has been lifted.
Regulators are actively facilitating structural updates now. The SEC is currently exploring a temporary innovation exemption. This would allow firms to test entirely new financial products, like trading tokenized securities on platforms that aren't traditional SEC-regulated exchanges without the immediate threat of enforcement actions. It creates a safe harbor for institutional experimentation.
So what does this all mean? If the banks are in, the stablecoins are yielding interest, and the regulations are clear, what are they building? The primary focus seems to be the end of T+2 settlement and the rise of real-world assets, or RWAs.
The tokenization of real-world assets is perhaps the most significant structural upgrade to capital markets since the transition from paper certificates to electronic trading in the late 20th century. We are turning blockchains into a unified, global, 247 clearing and settlement hub.
Let's talk about that transition, specifically the move from T+2 to T+0. For anyone who buys or sells stock, you know that if you sell a share of Apple on a Tuesday, the cash doesn't actually settle in your account fully cleared and ready to withdraw until Thursday. That is T+2. Trade date plus 2 days. Why on earth, in an era of fiber optic internet and algorithmic trading, does it still take 2 business days to settle a trade?
It is an artifact of legacy market plumbing. Decades ago, trades were settled by physically moving paper stock certificates via messengers in Lower Manhattan. To reduce the chaos, centralized clearinghouses like the DTCC were created to net out all the trades at the end of the day and update a central ledger. T+2 allows time for brokers to ensure the buyer actually has the funds and the seller actually has the shares, reconciling multiple disparate databases across different financial institutions.
But with on-chain settlement, it becomes T+0, instantaneous. The second you execute the trade, the asset and the cash swap wallet simultaneously. It is an atomic settlement. What is the actual economic impact of moving to instantaneous settlement? Does it really matter if a bank has to wait 2 days?
It matters immensely. Traditional financial institutions can increase their capital utilization by 2 to 3 times with T+0.
2 to 3 times.
Yes. During that 2-day waiting period, billions of dollars of capital are locked up in clearinghouses acting as margin to protect against the risk that someone might default before the trade settles. If settlement is instantaneous, counterparty risk drops to near zero. That margin capital is suddenly freed up to be deployed elsewhere in the economy.
And the projections for this market are just notable. The real-world asset market is projected to reach $16 trillion by 2030. Tokenized U.S. Treasuries, which are essentially government bonds represented as tokens on a blockchain, have already surpassed $7.3 billion. That is over 300% year-over-year growth. And now, on-chain U.S. equities are emerging at a scale of around $500 million.
This means that equity risk assets, like stocks or ETFs, can now be traded globally without geographic barriers. Furthermore, we are seeing non-standard assets, like private credit, hovering around $8 billion on-chain. While private credit is still constrained by pricing friction because it isn't as liquid as public stocks, it represents a substantial growth frontier for institutional capital seeking higher yields.
To capture this, the New York Stock Exchange is building a platform specifically designed to trade and settle tokenized securities natively on-chain. What is brilliant here is the hybrid approach. If you hold one of these tokenized shares on the new NYSE platform, do you lose your traditional shareholder rights?
No, the legal framework remains intact. You still receive your traditional dividends, and you maintain your voting governance rights. But technologically, you gain the ability to trade fractional shares, settle instantly, and fund the entire transaction with stablecoins.
Let me play devil's advocate again. I understand why a hedge fund wants instantaneous settlement to free up margin capital. But for the average retail listener, does it really matter if they can buy a fraction of an ETF on a Saturday night using a stablecoin?
It democratizes access and changes behavioral finance. Traditional markets dictate when and how you interact with your wealth based on geographic time zones and whole share pricing. By fractionalizing the asset and making it available 24/7 via a borderless digital currency, you allow microinvestments to occur continuously. It aligns financial markets with the always-on nature of the digital economy.
But to make all this instant borderless trading function properly, the digital currency side of the equation has to be flawless. You can't have instantaneous stock trades if the cash leg is slow or volatile. That leads us into the sheer scale of the stablecoin revolution and the rise of what the industry is calling CeDeFi.
The scale stablecoins have achieved is difficult to comprehend until you look at the comparative transaction data. We are witnessing the creation of an entirely new global monetary rail.
The data points are jarring. In 2024, stablecoin transaction volumes hit $27.6 trillion. That officially surpasses the combined yearly settlement volume of Visa and MasterCard. The blockchain is moving more digital fiat value than the 2 biggest legacy payment networks on Earth. And over 40% of this volume happens outside of traditional banking hours. It is filling a global liquidity vacuum.
What's fascinating here is how much this mirrors financial history. If we look for historical context, the closest parallel is the creation of money market funds, or MMFs, in 1971.
Let's dive into that. I think most people have a money market fund in their brokerage account, but they don't know the history of why they exist. Can you explain the 1971 parallel?
In the 1970s, the U.S. was experiencing high inflation. However, Banking regulations, specifically Regulation Q, enforced strict caps on the interest rates that traditional banks were legally allowed to offer on savings accounts. Consumers were losing purchasing power because bank yields couldn't keep up with inflation. Innovators realized they could pool consumer cash, buy high-yield, short-term corporate debt and government securities, and pass that actual market yield back to the consumer, bypassing the bank entirely. That was the birth of the money market fund.
So they routed around the legacy system to give people a fair yield. And you are saying yield-bearing stablecoins are doing the exact same thing today.
Yes, but at a vastly accelerated pace, enabled by global digital networks. The growth is compelling. Yield-bearing stablecoins grew 13-fold, going from $660 million in late 2023 to about $9 billion by mid-2025. Once the Genius Act provided the legal clarity, capital naturally flowed to where it was treated best.
How are these stablecoins actually generating the yield they pay out to users? I know there are a few different models.
There are two primary models. The first is through real-world asset collateralization. These are stablecoins backed directly by tokenized U.S. Treasuries. BlackRock's BUIDL token is a major player here, sitting at around $1.7 billion in assets under management, alongside others like Ondo Finance's USDY. The yields comes directly from the interest paid by the U.S. government on those underlying short-term Treasury bills. It is highly transparent and traditional in its risk profile.
Right, it's essentially a digitized, blockchain-based government bond fund. But the second method is much more complex. We see protocols like Athena issuing a stablecoin called SUSD, and they use derivatives arbitrage to generate returns that range from 10% to 27% APY. Okay, we need a serious plain English translation here. Delta-neutral hedging in perpetual futures sounds like a recipe for a catastrophic loss. How are they making 27% without risking the principal?
It requires an understanding of how crypto derivatives markets function. In traditional finance, futures contracts have an expiration date.
Right, a set time they settle.
Exactly. But in crypto, the most popular trading instrument is a perpetual future, a contract that never expires. Because it never expires, the exchange needs a mechanism to ensure the price of the contract stays tethered to the actual spot price of the underlying asset, like Bitcoin.
Okay, so if the contract price drifts away from the actual price of Bitcoin, how do they force it back?
They use something called a funding rate. If too many traders are long, meaning they are betting the price will go up, the price of the perpetual contract will rise above the spot price. To incentivize traders to take the opposite side and bring the price down, the exchange forces the long traders to pay a fee to the short traders. In bull markets, this funding rate can be incredibly high.
I see. So how does Athena use this to make a stable coin?
Athena takes your deposit, let's say $100. They use $50 to buy actual spot Bitcoin, and they use the other $50 to open a short position on Bitcoin perpetual futures. They're now delta neutral. If Bitcoin goes up 10%, their spot holding gains value, but their short position loses value. They cancel each other out. The underlying value remains exactly $100.
Ah, okay.
However, because they hold that short position during a bull market,
Yeah.
they're constantly collecting those high funding rate fees from the long traders. That fee revenue is what they pass back to the stablecoin holder as yield.
That is a clever mechanism, but it relies on market structure remaining relatively stable. If the market aggressively turns bearish and the funding rates flip where shorts have to pay longs, doesn't that yield evaporate, or worse, eat into the principal?
That is the structural vulnerability. Both the S&P and the European Central Bank have issued stern warnings regarding these types of stablecoins. They point out that these assets carry inherent depegging risks. If the yield mechanism fails, or if a smart contract is exploited, the token could lose its one-to-one value with the dollar.
So you are stepping outside the FDIC-insured safety net for higher yield? That risk is exactly why we're seeing the rise of CeDeFi decentralized finance. How does CeDeFi solve this trust cap? How is it different from just using a regular bank or a traditional crypto exchange?
Pure decentralized finance, or DeFi, offers incredible transparency and high yields, but it requires users to self-custody their assets and interact directly with complex smart contracts. There's no customer support if you make a mistake. Centralized finance, or CeFi, like a traditional exchange, offers user-friendly interfaces, regulatory compliance, KYC checks, and insurance, but they often act as opaque intermediaries taking a cut of your yield.
So CeDeFi tries to merge the two.
Exactly. CeDeFi platforms offer the high yield and peer-to-peer efficiency of DeFi protocols under the hood, but they wrap that interaction inside the regulatory compliance, institutional custody, and insurance frameworks of a centralized entity. It gives institutional fiduciaries the safety rails they legally require to participate in decentralized yield generation.
Before we move off stablecoins, I want to take a quick tour of where this capital actually resides, because not all blockchains are identical in their use cases. It's a highly segmented market. First, we have Ethereum. It holds $124 billion in total value locked, representing 52% of the market. But the average USDC transaction size on Ethereum is roughly $97,000. Why is Ethereum primarily used for such large transfers?
Ethereum operates as the foundational settlement layer for institutional capital. It has the longest track record of security and the deepest liquidity for complex financial applications. However, because of its architecture, transaction fees can be relatively high during times of network congestion. A $20 fee doesn't matter if you are transferring $100,000, but it makes the network unviable for buying a cup of coffee.
Contrast that with Tron, which holds $66.9 billion in total value locked, but dominates 41% of all stablecoin transactions globally. Who is using Tron if Ethereum is taking all the institutional money?
Tron has emerged as the primary network for cross-border payments, particularly in emerging markets across Asia, Africa, and Latin America. It is heavily utilized for high-value, low-frequency transfers by individuals and businesses who need dollar stability outside the traditional U.S. correspondent banking system. The fees are lower than Ethereum, making it more accessible for international remittances and commercial trade settlement in regions facing local currency volatility.
Then you have Solana. Solana is processing 10 million stablecoin transactions a week. Its fees are sub 1/10 of a cent. It seems built entirely for microtransactions. And finally, the BNB chain, processing 1.2 million daily transactions with zero-fee swaps, deeply integrated into retail trading ecosystems. It proves that blockchains are optimizing for different types of capital flows. But with tens of trillions of dollars moving natively on-chain, the traditional exchange giants are aggressively fighting for dominance. We talked about ICE and the NYSE focusing on tokenized spot equity. The Chicago Mercantile Exchange, CME Group, is taking a different path.
CME Group is doubling down on their core competency, which is regulated derivatives. Instead of trying to tokenize the underlying spot assets like stocks, they are building out the derivatives market for the digital assets that already exist. They are planning to launch 2047 crypto futures and options trading, and they've expanded their offerings well beyond just Bitcoin and Ethereum, incorporating assets like Cardano, Chainlink, and Stellar, effectively covering 75% of the total cryptocurrency market cap.
There is a notable metric that shows how successful CME has been recently. Their futures open interest actually flipped Binance. Let's define open interest first. What does that metric tell us?
Open interest is the total number of outstanding derivative contracts, like futures or options, that have not been settled or closed out. It is a primary indicator of liquidity and institutional participation in a specific market. When open interest rises, it means new money is flowing into that specific contract.
For years, Binance, an offshore crypto-native exchange, was the undisputed leader in derivatives volume. But CME recently hit $28.3 billion in open interest across the top cryptos, compared to Binance's $23 billion. Why is Wall Street institutional capital choosing CME over crypto-native platforms, and what does it mean for the market?
It indicates that regulated, traditional capital is now driving the primary price discovery for major digital assets. Institutions prefer CME because it operates within a well-understood U.S. regulatory framework with robust surveillance and traditional clearinghouse guarantees. It fundamentally shifts the center of gravity away from offshore, unregulated environments back to traditional financial hubs like Chicago and New York.
But it's important to note the structural differences in how these exchanges operate, specifically regarding leverage. You mentioned CME requires a 40% maintenance margin on their contracts. Can you explain how that impacts a trader compared to using an offshore exchange?
Margin is the amount of collateral a trader must post to open and maintain a leveraged position. A 40% maintenance margin requirement means that for a contract valued at $100,000, the trader must keep at least $40,000 in their account. This effectively limits their leverage to roughly 2.5 times their capital. CME prioritizes systemic safety and risk management.
Whereas unregulated offshore exchanges have historically offered leverage up to 100 times, meaning you only need $1,000 to control a $100,000 position. It's a completely different, highly speculative risk profile, which explains why Binance still dominates the smaller, highly volatile altcoin futures market, with about $7 billion spread across meme coins. Meanwhile, Nasdaq is making strategic moves in the indexing space, partnering with CME to rebrand their core index to the Nasdaq CME Crypto Index, or the NCI. Why does the market need another index?
An index is the foundation for creating structured financial products. If an asset manager wants to launch a crypto index ETF, they need a highly trusted, heavily vetted benchmark to track. By combining Nasdaq's index methodology with CME's institutional pricing data, they are creating a gold standard benchmark that pension funds and endowments can rely on for accurate valuation, free from the pricing anomalies sometimes found on smaller spot exchanges.
We also see Bakkt, a company originally founded by ICE, making aggressive capital moves. Bakkt just announced a $300 million at-the-market, or ATM, equity program. For listeners unfamiliar with corporate finance mechanics, what is an ATM offering and why is Bakkt raising that much capital?
An at-the-market offering allows a publicly traded company to raise capital by gradually selling newly issued shares into the secondary trading market at the prevailing market price, rather than selling a massive block of shares all at once at a discount. Bakkt is using this $300 million war chest to expand their Bakkt Agent initiative, scale their Zaira stablecoin platform, and push aggressively into international markets like Japan and India. They are building out the underlying infrastructure.
Here's where it gets really interesting. We have the new assets, the new regulations, the new stablecoins, and the institutional exchanges all battling for position. But that leads us to the most futuristic and, frankly, the most disruptive piece of this entire puzzle. Who or what is actually going to be executing these trades in the future?
This is the participant transformation. The industry narrative has moved rapidly from simply putting assets on-chain to building entirely autonomous economies on-chain. OKX Ventures has termed this the dawn of the kinetic finance era. The core actor in the financial system is shifting away from human traders or even traditional algorithmic trading firms toward autonomous artificial intelligence agents.
I want to push back on that slightly. Wall Street has had high-frequency algorithmic trading for decades. Computers already execute the vast majority of trades on the stock market. How is an AI agent operating in kinetic finance any different from a traditional trading algorithm sitting on a server in New Jersey?
Traditional algorithmic trading is highly constrained. A quantitative fund writes a specific set of rules. If price does X, then execute Y, and the algorithm follows those rigid instructions within a closed, proprietary system connected to a specific exchange. Autonomous AI agents in a blockchain environment operate differently. They are not just executing pre-programmed logic, they're interacting with open, permissionless financial APIs.
So they can make dynamic decisions.
Yes, they can analyze sentiment, negotiate with other AI agents, seek out yield across hundreds of decentralized protocols, and execute complex multi-step financial strategies without human intervention or pre-approval.
By 2027, AI-driven automated trading is projected to reach $5 billion per day. This is the foundation of the machine-to-machine, or M2M, economy. But why do these AI agents need blockchain technology? Why can't an AI just use a traditional bank account or a credit card to pay for data or execute trades?
A traditional bank account requires a human identity. It requires a social security number, a physical address, and a KYC onboarding process. An autonomous software program cannot open a Chase checking account. Furthermore, traditional payment rails, like credit card networks, charge significant flat fees per transaction, usually around 30 cents plus a percentage.
Right, which makes microtransactions economically impossible. If an AI agent needs to pay another AI agent a fraction of a cent for a single piece of data, it can't run that through Visa.
Exactly. Blockchain technology serves as the natively digital payment rail for artificial intelligence. An AI agent can independently generate a cryptographic wallet address in milliseconds. It can hold stablecoins. It can stream M2M micropayments that settle instantly for as little as $0.0001. It completely eliminates the friction of traditional Web2 subscription models, creating a fluid, pay-as-you-go, millisecond by millisecond economy.
But this introduces a massive trust issue. If we have millions of autonomous bots trading billions of dollars and buying data at the speed of light, how do we verify their actions? How do we know a specific AI model isn't malfunctioning, hallucinating data, or being manipulated by a bad actor?
That is the critical hurdle, and it is being solved by a breakthrough cryptographic technology called ZKML, which stands for Zero-Knowledge Machine Learning. Demand for ZKML technology has grown 230% recently as developers realize it is the key to trusting autonomous agents.
Zero-knowledge machine learning sounds incredibly dense. Can you break that down with an analogy? How does it prove an AI is trustworthy?
Imagine you have a proprietary recipe for an incredibly complex cake. You don't want to give anyone the recipe, but you want to prove to a judge in a baking competition that you followed all the required steps perfectly without substituting any cheap ingredients. Zero-knowledge proofs are a branch of cryptography that allows you to mathematically prove a statement is true without revealing the underlying data.
So in the context of an AI agent,
In the context of an AI, ZKML allows the creator of the AI model to generate a cryptographic proof that the model ran correctly and produce a specific output based on its training, without ever having to reveal the underlying private training data or the proprietary algorithm itself. Another smart contract can verify that proof instantly. It mathematically closes the trust loop. We don't have to trust the creator of the bot, we just verify the math.
that solves the technical trust issue. But what about the legal trust issue? If 45% of daily transactions are initiated by non-human actors by 2026, the traditional regulatory framework collapses. A human compliance officer at a bank manually reviewing flagged transactions for money laundering or sanctions violations cannot possibly keep up with 10,000 AI trades per second. How do you regulate an economy of bots?
The traditional ex post regulatory model, meaning you catch the bad guys after the trade is already settled, is obsolete in a high-velocity M2M economy. The solution is embedding compliance directly into the code. We are seeing the rise of AI-driven compliance middleware platforms, such as CypherL.
I was reading about CypherL. They utilize something called the SR3 tech stack to monitor transactions. How does code-level compliance actually work in practice? If a sanctioned entity creates an anonymous wallet, how does the system stop them?
It relies on complex on-chain transaction graph analysis. While wallets do not have names attached to them, the history of every transaction is public. CypherL's AI instantly parses the entire history of wallets' interactions across the blockchain in milliseconds. If an AI trading bot attempts to execute a trade, the middleware analyzes the counterparty's wallet. If that wallet is mathematically linked, even several hops away, to known illicit activity or a sanctioned entity, the smart contract automatically blocks the transaction from executing at the code level. Compliance shifts from a manual review process to an automated defensive moat built into the architecture.
And as these AI agents operate, they need reliable data about the real world to base their trading decisions on. Where do they get that truth? It seems prediction markets are emerging as the primary oracles for these agents, but why are prediction markets more reliable than just having an AI scrape news websites or polling data?
In an era flooded with AI-generated content, synthetic data, and biased news sources, scraping the internet for truth is highly unreliable. Prediction markets require participants to put capital at risk. They use financial skin in the game to determine the highest probability of an event occurring. Participants are financially penalized for being wrong and rewarded for being right, which rapidly filters out noise and aggregates accurate consensus.
And we are seeing regulatory compliance win in this sector as well. Kalshi, a prediction market fully regulated by the CFTC, charging nominal fees of around 1.2%, recently overtook Polymarket, which operates largely offshore. Kalshi hit $850 million in weekly volume. It demonstrates that as institutional capital enters these new domains, they prefer and will heavily fund compliant environments over unregulated alternatives.
It proves that sensible regulation, when properly harmonized, does not stifle innovation. It provides the bedrock required for the technology to scale to the trillions of dollars needed for global adoption.
We have covered substantial ground today. We started with ICE valuing OKX at $25 billion, proving the merger between Wall Street and crypto infrastructure is actively underway. We examined the Genius Act and the Clarity Act, which provided the legal clarity for stablecoins to generate yield and banks to custody assets. We looked at the mechanics of moving from T+2 to instantaneous settlement, freeing up billions in capital. And we explored the futuristic yet currently unfolding reality of kinetic finance, where AI agents execute microtransactions continuously across a borderless ledger.
If there is one core insight to distill from all these developments, it is that the definition of what constitutes a market has been permanently altered. Capital efficiency, the ability to move value instantaneously, programmably, and securely across the globe, has become the primary metric of success. The physical and temporal limitations of the legacy financial system are being engineered out of existence.
The walls are indeed coming down, replaced by open source code and global networks.
And this raises a compelling question, a final thought to ponder as you navigate your own financial strategies in this environment. As regulatory harmonization advances globally, and as autonomous AI agents begin executing complex trades on a unified ledger using natively digital yield-bearing currencies, what happens to the traditional concept of a national economy? When a fraction of a U.S. stock, a digital token backed by a treasury bill, and an automated prediction contract can be swapped instantaneously by an algorithm operating independently of any geographic jurisdiction, do national financial borders retain any functional meaning? Or are we currently witnessing the silent birth of the first truly sovereign digital global economy?
That is an incredibly layered question to consider. The political borders on our maps remain static, but the borders constraining capital seem to have completely evaporated. Thank you for joining us on this deep dive. We encourage you to stay curious, continually question the changing paradigms around you, and explore how these underlying shifts might impact your own world. We'll catch you on the next deep dive.